All right, hello. I'm going to try a little bit of a different video today. I don't know how this works. And if some politics are it seeming to be a little political, I'm sorry, it's not meant to be. You can have your own opinions about this. And what I am doing is just revisiting a project finance case. And I'm trying to show you that if you understand project finance, and this case is from Venezuela, and it was a very famous case. And if you can understand and work through some of the analysis and understand project finance, you can also understand other things in the world because I'm sick of kind of hearing people babble on about this stuff, and then you can say, "Oh my God, we did just this one case." Now, a nice person also told me, "Where are sessions 1 and 2 when I'm trying to make all these little weekend sessions we have?" And I'm going to try to make some other videos as well. So I'm going to in sessions 1 and 2, I talked about IRRs and timing, distortions in IRRs, why the IRR as a financial statistic is not bullshit, like these people at Amsterdam Institute of Finance said it was. And I got all emotional about this before. And I'm going to do this in the context of a case named Petro Zuata. And I'm going to revisit this case that I used to teach when I was really nervous, and I would read these Harvard Business School cases and think, oh my gosh, I better understand this, and I better um, uh, I better be able to talk through this. So I said, oh, let's go through this and these cases. Let me before I walk you through these cases, let me tell you where you can find these. Now, in if you basically if it's a Harvard Business School case, I'm not at all allowed to post it on my website or anything like that. Suppose you could perhaps request the resources. That's all I'll say. So in the resources, there's some case studies, and one of the case studies down here is Petro Zawata. Now, so I have the Petro Zawata case. I have a Petra Zawata teaching note where it was kind of interesting. They said, okay, if people at Harvard and all these business school are going to study this case, here's what they should do. And then I've got an article written by a very nice man named Ben Esty. I haven't spoken to him for 22 years or something. I hope he's doing well. And he said his article was titled Petro Zuata, a case study of the effective use of project finance. Project finance. And then most importantly, well, let me perhaps go through the case. So the case, now, when I am absolutely not sure how these cases really work, I have seen people use these cases, make up kind of fake ones. This is clearly a real one, and there's clearly a lot of data that is, if not real, from the actual transaction, probably really pretty good and pretty close. So the case begins with some little story about blah, blah, blah. You were some big executive, you're some big whatever financier, and you have to go to New York and back to Venezuela and blah, 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 blah. And then they describe PDVSA. Now understand that PDVSA is the national oil company of Venezuela. It's essentially the off-taker for this transaction. Then they discussed this business which was where Venezuela was going to encourage private investment. Oh my gosh, private investment for oil companies. What are we talking about these days? And they described kind of the oil and this belt where it was going to be taken from. And then they described the sponsor, Conoco. Right now, Conoco is called ConocoPhillips. I just put some petrol in my friend's car from Phillips 66. I think it's an old oil company, a major certainly. And the SPV, the separate corporation that was going to own, it's actually not only the oil, it's not only an upstream project, it also had some pipelines, and some refinery capacity. And so you go through and it gives you a diagram. And you might, when you look at this, I try to look at some data, and they go through the costs, and they do go through some of the terms, the offtake agreement, a little bit on some things like force majeure. They had a cash flow waterfall, and look at this. They had to maintain a 1.35 debt service coverage ratio, or I suppose probably doesn't see that tell you, but they probably couldn't pay dividends, or they might have had some provisions for volatility of the oil price. And then they go through some of the sources of financing. And for me, kind of, that if I hope I can find this, financial projections. I thought one of the most interesting paragraphs was this one. Okay, let's see if I can. Okay, and so we're getting into kind of what's going on really in Venezuela, obviously. In terms of operating costs, the project's major post-construction costs include labor and overhead, 38%, well servicing, 15% utilities, 13%. So these are kind of, we can almost call them fixed costs and maintenance. Its funding and development costs were only 0.25. That's like a development expenditure we have in any project finance in comparison with other projects, blah, blah, blah. Okay, and then it was the interesting one. So they had a low development cost, and furthermore, Petrozuata's, this SPV's cash operating costs were 3.19 USD per barrel, which you could compare to the oil price. Now, what is it? 60? It was 100 a year ago. It's gone up and down, obviously, but 3 seems pretty low, and 3 might be really, of course, it's inflated. Please, but it's a low cost, and they say well below the cost of a couple others. The really interesting part would be to look at what the break-even oil price is for this project versus, let's say, shale oil projects, I think. Of course, we don't have that, but we have some of this. And then we go down, and they give you some statistics on Venezuela. It's not so good. It had some big ups and downs. Look at this. They had interest rates that were enormous. Okay, and all right. And the argument about this one was, oh my gosh, we could finance this. And I suppose DuPont owned Conoco at this time. I don't know. Now it's ConocoPhillips. Sorry, I don't know exactly what happened with all of this. I just got to be honest, and I don't know why they even gave you this a little bit. Okay, these were the DuPont and PDVSA. Remember that? Oh, I almost thought Petrozuata. PDVSA is the national oil company. don't know why they really compared those. And then they have a little diagram of this famous oil belt, and there's Venezuela, and there's Conoco, and they have to take this. If you look at a picture of the oil in Venezuela, it's this mucky kind of stuff that looks like something I should not talk about. And it's not night, it's light cool. And there's all this discussion these days that all these refineries in the US were built to actually take this heavy oil, and now it's different than lighter oil. This diagram, it's just for me, it's a disgusting diagram. I know this is probably from the documents in the project, but why don't they just kind of put PDVSA, they're paying. And well, we kind of know what happened. This project got nationalized. Okay, it was taken over. All right, but PDVSA would buy the oil from Petrozawatte. Some of the costs were paid, presumably, for electricity and other things. They were provided by the government, essentially, of Venezuela. And then you have the sponsors, and they don't, I guess, do they show the banks here? So for me, it's not a diagram that really nicely synthesizes who's paying the money, where is the money going, and what are the big risks of the project. So then they give you a uses and sources of funds, a wonderful thing where you can see what happened, and basically they issued a big bond here and then some more debt. I don't really know. And at the end of the day, we've got 1.45 billion of debt compared to expenditures of 2.4 billion, and you can compute the debt to capital ratio. Okay, and they all came from these Petrozawatte planning documents. And then, oh no, then there was some general stuff about other oil projects that weren't project finance. I don't really care. There's a little kind of thing on interest rates, and Venezuela had a below investment grade rating. So this was supposed to be a fantastic project because I'm not even sure what kind of debt cost they got, but we can answer that because then they gave you the gold mine. They gave you a little bit of a cash flow forecast. And as soon as you see a cash flow forecast, what I want to do is compute the IRR. And when we compute the IRR on equity and equity IRR on the project, we can see a lot. But when you do that, look at the oil prices. No inflation. 18 US dollar oil prices. It's not exactly what the oil price is today because there's a little discount because it's heavy oil. But we can kind of, the first thing I would want to do is compute the IRR on the debt. Oh, we could get the debt inflows and outflows, compute the IRR on the debt, the IRR on the equity, and the IRR on the overall project, and discuss whether this IRR is as perfect as a statistic as we think it is, and that's what I want to get into. Now, and once we have the IRR, we can say, well, then we can make some conclusions. Is this a fair deal to people in Venezuela? Was this Conoco company coming, and I think they're in Texas, I'm not sure. Were they coming to just, as one person, I was really lucky. I met some people from PDVSA who were not at all kind of, this was well after the project was nationalized. This man, he was really nice. He was not anywhere near somebody who's a supporter of Chavez or anybody else. He was very realistic and about the waste in the company and all that. But his comment about this transaction was that it's like And when they negotiated it, it was like Columbus coming to the Americas and trading whatever, God knows, a couple of little things for all the gold. They didn't know what they were negotiating. This was his point. Whether that's true or not, it was kind of interesting. They give you the interest rates, and then what they do here is they give you this cost of capital. And this, I am sorry, if anybody at Harvard would look at this and not question this, I would go crazy. The first thing they did is they unlevered and relevered beta, which is an absolute crime in project finance. Then they said, okay, a risk-free rate of 5.6. Okay, at that time, fine. But then they have a 7% equity market risk premium. Oh my God. And that they weren't even finished. They put another 2.1 as a startup company. And you didn't look at the kind of upsides and downsides and all this. And then on top of that, they put a 6.67 country risk premium to tell you that they need 21% equity return for this project. And what do you have any idea what 21% means? It means that if you have €1, €1, one, whatever, it grows by 21% in the next year. And that 1.21 grows by another 21%, and that 1.21 grows by another 20%, and another 20%, and if they were earning a 21%, they're saying they're just basically breaking even though they have no inflation in the oil prices at all. And can you imagine what that would require by the end of 2034? Now, uh, this deal got the name to be the project financing deal of the year. No, it wasn't only the deal of the year; it was the deal of the decade. Oh my gosh! And and this was the teaching objectives of the case. We're not supposed to look at what the balancing of the interests between the buyer and the seller and whether this was really an economically efficient thing to do. We're supposed to illustrate a well-crafted streels that why companies would use project finance. It shows how project finance creates value. Well, it does create value from somebody. It explores the potential for capital markets and describes corporate bond rating process. Oh my God, in terms of sovereign and blah, blah, blah. It illustrates some of the financial analysis tools. And then they suggest using, I made a video a long time ago. What a lot of BS. They suggest making a Monte Carlo simulation on the oil price or something here. I don't know. You can look at this and it's kind of crazy. Even it's laughable. I'm sorry. Deal of the year. Superlatives. Highest rated Latin American project. Okay. I don't think I'm giving away some big story by telling you that this project, I already did tell you, it was taken over. Not immediately. Chavez, when he first came in, he was he didn't interfere with the investment at all, and then I forgot when it was taken over by PDVSA. And I'm not going to get into any of those kind of things. What we are going to do is instead go and look at this data that they gave us. Okay, and now I just want to show you a little bit what I would do with this case, not what they did. Now, I did a little bit of other things, and so now I'm just going to compute some IRRs, look at some issues a little bit differently than just looking at the IRRs, and I'm going to go through some Excel. You can stop it. No, maybe if you don't, you at least, I assume, you want to see what the IRR is, don't you? That's an IRR, again, these assholes, sorry to say it like this, who say, IRR is ridiculous, we should go to NPV or make MOIC or payback periods or whatever in the heck we. The fact is, when you go, you talk to anybody from a development bank to the Green Climate Fund to a private equity investor to project finance, the first thing they do is they look at IRRs. And why do they look at IRRs? IRRs, as I've been trying to say so many times, they are essentially growth rates. So I'm getting my little coloring thing. So that's first thing we better do is the most important thing. We better color those sheets, okay? Okay, and this was, I think, given to us in Lotus. I don't want to put a title on this sheet, I don't think, and we can see what's an input and what's not. So what I did is a little bit of a restructuring of this. I suppose, what I always like to do here and is go through this. So let's, oops, I can't do that. Those are, if you haven't recalculated, oh shoot, just a minute, just a minute. Should have practiced a little this. I thought, I don't really have to practice this at all. Okay, so let's first see, we've got some, let's just start by taking their numbers. Remember, these oil prices, the most basic thing we should do is kind of inflate these prices, I think. Okay, but even before that, let's just compute some cash flows. So the first thing they did is they gave you the equity cash flows, and they gave, horrible thing where you, please never merge one of these cells, but dividends and then the investment. So let's put the net equity cash. Is that okay? I think that's okay. And we'll say, this is the cash that comes out of your pocket, plus this is the cash that goes back into your pocket. Hopefully we can just double click on that. Why can't I? Oh shit. Oh, I'm going to do what all these people do. Okay. And then I would almost want to graph this. Maybe F11 to make a graph. Okay, there's the equity cash flows, and because of their assumptions of the oil price not going up, we have this kind of pattern, and I guess they funded it a lot with a bond up at first, and then immediately, okay, the very first thing I would do, and maybe let's do it up here, and let's put equity. Should we put it here? Equity IRR, okay? And we just put IRR, it's just nice and annual and 26%. Now, okay, you think, oh, well, what's 26%? Is that really that high? Well, it's as if, let's not get too fancy. I was going to get fancy and illustrate how to prove that this is a growth rate, and I cannot quite do it in this example. Let's start here. Let's just put a 1, and then let's say we multiply this by 1 plus the 25%. I should prove this to you. The reason I'm not proving this to you is I'll get a little off track. I know myself a little too well. And why in the heck doesn't this go down? Okay. Control D. Okay, that 1, did I do this right? I better press Shift Control Q. That 1 becomes 3,644 in nominal terms. Or if you graph the stock price of this company, This is kind of what the stock price will do. Now, frankly, the S&P and other indices look a little bit like that. There's been very high returns earned by different companies, and I'm going to show you that. Now, we could also do one other thing that I suggest is a little interesting. We could say, we could put in here the premium above, let's write it like this. RF. Okay, and right now, out of all this crap that they're having you do, and I'm going to put the RF up here of 5.4%, was it? I can't remember if it was 5.4, 5.6. And we can compute what we can do. Let's just do it kind of here. Let's say that let's just start up over here with our dividends. Okay, these are our dividends, and let's take the NPV of 5.4% of all of this. Okay, and so we get 3.5 whatever billion. Okay. And now I understand that some man was saying, "Oh, these people took our oil." They didn't take. I don't think it was a man. I think he didn't mean we're gonna take the shit. We're gonna take the oil. I think he meant we're gonna take the money. And for that, you've invested in simple terms. I should future value this. But in simple terms, the investment we made in equity was this. Okay, now just that number, I hope, and let's put a minus on that one. And that number says that we are earning this much relative to an investment. We're earning 568%. That's the premium we're earning over and above the risk-free rate. And we could try to kind of convert this. So I'm going to call this the equity investment. Okay, maybe I better wrap the text. And then this is our premium. Now, the reason I think the IRR has taken over the world, it's a statistic that kind of not perfectly at all represents growth. NPV, what does that mean? You put a different discount rate, you get a different number. XIRR, what a bunch of horse shit. It doesn't come close. And you have to, what happens with XIRR, you put a refinancing rate in or whatever, a financing rate or a reinvestment rate in, and it gives you all kind of the same number you put in. If what we need to do is, if we could find a way that eliminates the distortions of the IRR, it is kind of interesting. Maybe that would be interesting. Now, before we, how about let's go over here and let's try to compute the project IRR and the debt IRR. Now, so we have the net equity cash flows. Now, if I would want to compute the project IRR, I'm not going to say this because I believe so strenuously against this whole idea to say that can you imagine if this project was in year 25 and it had made it through all sorts of different governments, everything was operating smoothly, everybody was happy with the project, the risk would be relatively low on this project. The risk is kind of as highest at the beginning of the project and when people kind of see the returns. And there was political risk. Right now, there's a gigantic political risk. I saw Orsted recently, Orsted, EDF, Iberdrola, they all lost billions in a country where their wind projects were just, okay, there is political risk. How we measure it and how we assess it, and the danger for me with political risk is that you get a high risk premium and get a really high IRR. Then the returns or the cash flows, if it's a project like an infrastructure project, the prices are really high, and then people are saying the prices are too high, and there's political risk because the politicians will come in and lower the prices. In this case, if the returns are too high, they're going to say, "Oh my God, you're stealing money from the country." So this high returns that are driven by political risk have a circular kind of process where it causes problems. I don't know if this is working. I hope it is. Let's compute the debt cash flows. Okay. And then when we compute the debt cash flows, let's take here's the total debt. So we have the amount of debt you issued. In this case, the amount of debt you issued is the difference between this number and the prior number. So we didn't issue any there, and then we issued this debt here. And did we issue kind of one more? And then, oops, I guess that's fair. This debt kind of went up, and then the debt is going down, and I am not sure what they did with the debt service reserve account, which if we just take this whole line here, you see it sums to 1, which should be 0. So they're putting it in and taking it out. Let's do it without the reserve account for now. So what they do here is after here, they start repaying the debt service so that we don't look at how much the debt went down. And I'm going to kind of put a little parentheses here and make this one a negative. All right, I know that's against some people's Excel beliefs. And then we're going to start repaying the debt service. And let's just do it with that. I suppose what we could do is that I think for a reason I will explain in about 1 minute, this will be changed. Again, you might want to even do an F11 on this. You can see that what they should really be doing, I don't know what happened here. There's probably some negotiation, and you really want to make sure these things could be called reserve-based loans, that the speed at which you take the debt, where's the, so this is when we don't really have a classic, yeah, almost. This is when they're producing, and as you're producing more, you should be having a higher debt service, and then it was supposed to flatten out. This is not like a regular old kind of, maybe I'm going to freeze the panes, okay? So we have this debt cash flow, and we could get the debt IRR and see, well, how much are you making over and above the risk-free rate, okay? And this is pretty good. If you want to say this was a good project because they were able to get this kind of interest rate. Now, my first question and my interesting question would be, okay, this debt probably could easily be repaid. And we could even, let's just do the other thing that we should all, DSCR. They give you the cash flow and they give you the debt service. So once you have the cash flow, and I hope that this is the kind of thing, Shift Control Q, this is the kind of thing you would compute. They give you, and this is when they lowered the debt service. And you could even compute the LLCR as the net present value of the revenues divided by the expenses, or you could take these kind of numbers and say, we've got a, let's compute the LLCR, okay? And if we computed the LLCR, here's, it all comes from one thing. We can take the debt amount, and let's just, I'm doing this a little bit simplistically, okay? But let's take the total debt that was issued here, okay? That's the total debt amount, 1.45 billion. I think I can remember that number from the sources and uses. And then you take the NPV of the cash flow, CFADS here, and let's take that cash flow, and let's kind of cheat. And of course, when we take the NPV, we take this number and we say, okay, well, let's take the NPV beginning at this number. Is that okay? And going down to kind of where we finished repaying the debt here. And so this is the PV of CFADS over the loan life. I'm not going to even write that down. And we get this sort of a ratio. So, and what that means is, I'll call it a break-even cash. I'm not going to write down the cash, but what you do is you take this number minus 1 divided by this number. It's easy to prove. And this shows that the cash flow can go down from these low oil prices. And of course, you could get the operating expenses wrong, but it could go down by 67.45 before you haven't paid off the debt. So this all works because of one thing, because the project IRR, and that's our most basic idea in project finance, and that's what I am going to do what that very nice man asked to do, which was to put videos in for those first classes. But rule number 1 is project IRR better be higher than the debt IRR. So let's compute the project cash flows. Now, we really should start with the project cash flows, but if we have the debt cash flows, and I hope that we put the equity cash flows over here, so I've kind of done it in a, let's make our spreadsheet be a little bit better. Let's put our project cash flows, which is just the equity cash flows plus the debt cash flows. Now, maybe they had asked you to do this at the very beginning of the project. I kind of don't really believe it. When I saw that teaching note and I read that nice article by Ben Esty, which didn't come close to evaluating the real issues, I was not convinced. And then we can put the project IRR. So if if we put our project IRR, let's take this one. Where did we put it? IRR of this one. Okay. Obviously, this is and then if I have 14% IRR compared to 6% debt, you're going to get this kind of IRR. Now, this was still in this teaching note. So what they had done here, these assholes, they said, oh, okay, our cost of equity is 20.97. So maybe you students, what you should do is you should go and what you should do is go and compute the NPV. Okay, NPV of, I can't believe I'm even wasting my time doing this. The NPV of equity, and to do that, we'll just uh, we'll put in that wonderful 20, was it 0.97%? I can't remember. My God, what a lot of crap. And this number, what this number just proves. I'm sorry. I hope this is not political against with Maduro and all that. What I'm trying to say is, can you imagine the incentives? You want this IRR of 20.97%, uh, or 25%. You have to go and say, oh no, our cost of capital is really high. We got the risk premium, 2.1%, whatever risk premium. We unlevered and relevered the beta and multiplied that thing by 7%. And then we got this crazy, what a crazy number. Oh my God. Oh my God. Okay. And when you, when you take the NPV I'm not going to bother doing it with the whatever of all of the cash flows, you get some number, 113. And what you're supposed to do with this number, who knows? If you put 27%, it's negative. If you put the cost of equity is a little bit higher than the cost of debt, maybe 8%, then you get a really big number. It all doesn't mean much to me. What means much to me is doing some kind of assessment about what's going on. Now, let's do a little bit of a sensitivity. Now, how would we kind of structure this? I suppose let's make, when we do this sensitivity, the first sensitivity is let's put different oil prices in. Now, when I did this, I suppose I suppose what we could do is I'm going to press Shift F11 and I'm going to put input C and in. How about input put C and S? So what we could do, and of course when you do this, I'm saying of course we could for the oil prices. Uh, let's first put our year here, and then did they have the year? So let's just do it. Practice a little Excel for the moment. Let's go up to the put equal transpose, and you can see I'm going CMAL a little bit, and then we can automatically kind of get everything done quickly. Okay, and let's put the base oil price. Okay, and once we have that, let's kind of go and let's use a transpose again. Boom. All right, and we got all of that. Now how about let's do one simple little thing, and let's add inflation. Let's put right no, I'm gonna put down here inflation in oil price. Okay, and let's see kind of what they did. Now, you can imagine perhaps that I don't know why they wouldn't have put oil price. If I'm a little skeptical, uh, uh, shift control P and shift control R, and that's what we kind of went. And so they were having about a 2.5% increase in the oil price, and then they stopped it. So now let's just use their oil prices with inflation, with future inflation, something like that. Okay, and so now what we'll do is I'm going to kind of do something crazy. I'm going to copy edit space, Alt ESV I use. You can use Alt H, blah, blah, blah as well. Okay. So this time I'm going to take the inflation oil price base, and then let's put our inflation in the oil price with future. So let's just put this in, Shift Control R, but so this is just an input. I don't see anything wrong with doing this kind of thing. Just put a future inflation in, and then we'll, okay. Now let's do another thing. Okay, let's, uh, I'm going to go to my website. Okay, oops, I didn't want to do that. Here, I seem to have it here. And I'm going to go to the databases, and I'm going to go to the commodity prices. I was going to do this a little differently. And when we go to the commodity prices, let's just get that thing. I hope I'm going to get that. When you do this, you've got a right click. You've got to go to the properties, and then you've got to unblock it and press apply and okay. So let's just put the actual oil prices in, and let's kind of now when you do this, the first thing you can do is let's read all the monthly inflation, okay, monthly commodity prices. So we have it till, uh-oh, I think that might be okay. 2025-11. I'm a little bit afraid that they changed the website, and I might have to go back here and fix it. It's really good what they do, and then you can read. Let's read the inflation rates in here, and once we read those inflation rates, there was some controversy about this a little while. We got enough inflation rates. Okay, so let's look at our oil prices. Come on, there, and let's go way back before, the big deal was when I was learning to drive in, I should know when I got my driving license. Yeah, that's after this, a little bit after this, and right now I'm showing gas prices, but let's look at average oil prices. Maybe what we should do is take the West Texas Intermediate, which is, and then we can do a little bit lower. Now this, we can do this in nominal prices, which you can see the prices in the 1990s were low, but then they went up and of course came down in 2008. This is the nominal prices. And I don't want to waste too much of your times, and this is getting a little bit long, so maybe let's just put in the regular old oil prices. So uh, uh, let's um, let's get a monthly. Let's just get these three things, okay? And I'm going to go and just copy these into a new little. Let's just put those as values. There was the old oil price. Now, up here, if you want to work with this kind of data, that's what we've been doing too. This was 1/1/1960. And if you want to press Shift Control 3, you can do this, and that was the next month. So how about this? Let's just put equal E date of this one and go 1, and then Shift Control 3. And then if we want, I know we could have got the actuals, but let's put 1996. And then what you can do here is put equals sequence, and then we'll go, I don't know, let's go from 1996, let's go for, seems like that's about 30 years ago, so let's put 30, and let's put nothing in the columns and put 1996, and then let's put a average if, and here's what you do. oops, we're not quite ready. We put up here, we put the year of this, okay, and then click on that, and so let's put the let's put sum if, no, average if. I wonder if I'm getting too old. And then we take the whole thing, and then we take this, and let's take this WTI, and we got 22, and let's lower this by, okay, how about, we probably should lower this for the crude, let's take 90% of this, okay? Okay, that's our main crude that we had in this thing. Okay, so this is the actual price, and then let's put that, so the first thing we can do is take this price, let's just start here, and then in this one, we take this price times 1 plus the inflation rate, okay? And then after that, we put uh, the actual oil price, and let's do transpose again, and get our actual price. Now, some people could say, "Oh, you shit! I'm give you a, I'm going to give you a thumbs down." Okay, fine. I'm just trying to do this, and I guess whatever. After that, I'm just gonna, after we go, okay, and now I'm gonna copy its specialist values and just take this and multiply it by 1 plus the inflation rate or something like that. Okay, so that's a little bit of a difference. I mean, I would kind of, if you want to graph this, take this year and put it somewhere else, delete this one, and kind of say, okay, let's make 3 oil price scenarios, and then look at kind of what the actual oil price is. So that 25% IRR is becoming kind of nothing, and then let's do something that is considered illegal. Let's put a oil price code number. So it'll be 1, 2, or 3, and then let's put the applied. So put equal index, and you select the area and go and press this, and you can do this with lookup and other things too. So if we press number 2, oops, I pressed F2, 2, we get that, 3, we get that. And then let's do a little spinner button, or not a spinner button, a drop down box. Okay, and when we do that, you right click, go to format control, and when you go to format control, you go to another sheet, back to this sheet, and take the 3 little names we have, and then you go to another sheet, back to this sheet, and take the code and press OK. All right, and then now we can do all of our we can do our little analysis. And what I did here is, now we can take our little thing here, and I'm going to do one more thing after this. I'm going to, so what I'm going to do with this is try to show you the difficulties in interpreting this kind of IRR, and maybe what some alternatives are to the IRR. And why could I not? I could copy it. So this time, instead of this price, and this was this times this, and then I just divided it. So we got the production, and all you can do here is put equal transpose the other way. God, is this so much nicer than the way it used to be? Okay, and up. Okay. And oh, why did it spill? Oh, I did I have something here? Okay. Actually, that's totally fine because I didn't need it. So So now if we put the actual oil price in, come on, okay, okay, just a minute, I better pause. Okay, I've corrected the oil price. I did something wrong with the transpose. You probably saw what I did wrong. So we have our three different oil price scenarios. And then there was a little confusion here, but let's just kind of get the basic right. We don't have to go crazy with all this stuff. Here's the revenue of this oil price. Now, there are some costs like royalties, like taxes that would certainly be variable. So this is overstating the effect of these variables. And let's see what happened here. Look, there was kind of continued inflation. So at least with this scenario where we started with our oil price and then we put the inflation, I think maybe we can leave this alone. But when we really increase the oil price, some of it clearly does go back to the government. But I want to stop and get this video finished. So here is, we can do it in this thing. Here is let's start with our base case. Here is this case, this one minus the debt service, and we add back the other one and we get exactly the same result. Okay, and then I hope everything stayed the same. What was this 25% thing? Where did I do the equity cash flow? So this equity cash flow is still 25%, but perhaps I should have put it over here, this little wonderful little thing, Bob. Come on. Oh, shoot. Okay, fine. I won't do it there. I'm going to just redo it over here. Who cares? Okay, so uh, okay. So if we have our base oil price, we get this IRR. Now, I hope I redid the equity IRR. I might not have done that. These are computed. Okay, yes. Whoops. Oh no, the dividends, or no, I just did the dividends. What I need to do, of course, is redo our coloring. So when you redo that, reset the colors, and let's just make sure we kind of show what's an input and what's a calculated variable. So these equity cash flows are calculated. We left the debt as fixed, fine, and we left the debt service reserve account as fixed. And we have our equity IRR of 25% with our base oil price. It's kind of, I don't know why. Who cares about the coloring of the top thing? Oh, that's because I inserted a line, okay? If we do it with inflation, this is kind of crazy. The inflation, and this is what I'm going crazy about a little bit. If we look at this case, it produced a break-even point, shift control G, of 67%. If we, oh no, okay, I guess I was a little bit wrong. I thought that would have increased the cash flow. Let's just add up all of our cash flow. Okay, and maybe I was totally wrong. 13 billion or whatever. 8 billion. So it went, the cash flow went from 8 billion to 13 billion. And because it's far into the future, and no, that's the break even. I'm totally full of crap. I'm sorry. I'm looking at this premium over here. This is the premium versus RF. Sorry about that. And that's what I want. Oh, I was just about to really be sad. Okay, so oh, come on. So if we put the base oil price in, we get a premium above the risk-free rate of 568%, 753. The IRR hardly was impacted, but the amount you earn over and above the risk-free rate, and that's not some controversial kind of figure. Now, if I would take and put a PMT, a levelized a payment, which we're good at in electricity, and we use this rate, and I forgot, I think 35 years, I can't remember, and we take where's the this one? I'm going to put PMT of this premium we earned. Instead of computing in 1 year, let's compute it over the 30-year life. So let's take and let's use the risk-free rate to levelize it, and that's kind of a conservative thing to do. And then we take this, and we better put as a minus here. Whoops. This is if we compute another statistic, which is the levelized premium. First of all, we get 36, we get a much higher number. And you can argue with me that this is not a perfect kind of ratio, but it doesn't have this distortion where it, because of compounding returns, it understates the value of the out year return. That's the one I wanted to show you. So this equity IRR was extremely high. The amount you actually get out, and you can see why people want this oil now. Okay, finished. Except let's put the actual oil price in. Oh, I can't get it. 56% IRR. I would say 56% IRR. Now I could, like I said, that could be overstated. And then if we use our levelized premium, we get a different number. You can see how I hope I'm going to stop here. It's about IRRs. It's about looking at a case. And the very first thing to do in any of these cases is get the IRR and start understanding what's going on. I'm not going to make any conclusions or anything else, but when I've been watching these videos and thinking about this, these kind of numbers do a lot more. I think I'm even going to put this, I'm going to call this Petrozalata revised data. Just so you can think, I just want to give you some ways to think about some of these issues, and I guess I'll stop now.